universal versus whole life and where that fits into your world and what the purpose is, right? So people, this is one of the first things that got introduced to me when I moved into the bracket where really it was where people were like, ooh,
we want to sell you things.
Yes, we want to sell you things.
You've got money for us to make commissions on.
And the commissions are absurd. The commissions are so big. And all of these, high net.
Especially when I first started being a life insurance agent, I was designing it straight commission. My first few years, I didn't know any better, So, it's less likely to happen these days. I feel like you're getting a lot more educated insurance professionals out there. I actually feel like I deserve a small amount of credit for that with some of the books I've written.
No, 100%.
But
so just where does it fit in general? Like overarching.
I have 27 insurance policies. That includes policies on my wife, my kids, business partners. And my first ones were $50 a month, $250. So I grew but only one of them is an indexed universal life policy. Those are oversold because they illustrate well, but they illustrate well on the non-guaranteed side. They illustrate horribly on the guaranteed side. So you have to ask, why do you have this policy? I have whole life policies because I want stability and access. When I'm now chasing a return, they have levers they can move based upon risk management factors like M&E expense, which is your mortality and the experience of how many people die per 1,000 bundled in that policy. And as you get older, your cost of insurance go up, but they're hidden on the illustration because you haven't touched your cash value. When you touch your cash value, they run on net amount of risk. So it's your cash value and your death benefit. They subtract the difference and say that's your net amount of risk. Well, that looks great, illustrates great. But in reality, there are no deals in insurance. And I feel like the cost of insurance inside of most indexed policies, it makes it look good up front, but there's surrender charges unless you're really wealthy. And then they can get them without surrender charges. I've done some of those before in strategy, handing people over. But I look at the long-term performance and the guarantees. I want access to my cash without creating a lack of guarantee to the cost of insurance. And so it might not illustrate as well, but I think the economic value of certainty is worth it for a lower illustration that I think has a higher likelihood of sustaining at a guaranteed level. And I want my death benefit, no matter what, to be around the day after I'm dead because I actually use it to increase cash flow with other assets.